Hello, Chart Watchers, and welcome to this Tuesday, May 8th, Market Watchers Live Show with your hosts, Tom Bowley and Aaron Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, the market is consolidating today. You can see the Dow Jones Industrial Average currently down 35 points, the S&P 500 down 4.5, the NASDAQ down about 10 points, the Russell 2000 again on a relative basis outperforming, trying to break out above the April high, currently up 3.5 points. 10-year Treasury yield back on the move higher, up 2.98% as money rotates away from the bond market. Volatility down below 15 earlier today. We are just slightly above 15 at 15.04 currently. Financials having a strong day, although we are off the highs of the day. We're trying to move back up and challenge resistance from the past couple of months. Industrials also doing well. Industrials, as you can see on a relative basis, not been performing very well, but we are on right now a 4-day winning streak. So industrials trying to gather itself here. Utilities having another rough day. It's been down 6 of the last 7 trading days, and we are down about 1.6%. That is the worst performing sector in the market today. And among the industrials, I wanted to pull up these 3 stocks. GE is the top stock in the Dow, or at least it was as of about a half hour ago, up 1.35%. And on the S&P 500, the top 2 stocks, Expeditors International, you can see up 7.66%, and Jacobs Engineering, JEC, up 7.86%. So some good action in the industrial space today for sure. And with that, let me bring in my co-host, Aaron. How are you doing this fine Tuesday, Aaron?
I'm doing quite well. We're going to have temperatures not in the 90s. It'll be 89. So I'm looking forward to that cool off right now.
This is a big day for me. Do you know why?
Why?
It has nothing to do with my workshop.
Yes.
The Caps.
Yes. Congratulations.
We eliminated the Penguins for the first time since 1994, and for only the second time in the last 11 meetings. And so the Caps are on their way. You know, I was talking with John Hopkins yesterday, saying how Washington area sports teams over the last 20 years are 0-13 when they have a chance to advance, to win a game, to advance their conference championship. That streak is over.
Woo-hoo!
Yes, they won in overtime last night, 2-1, and they are on to the conference final against Tampa Bay Lightning. So I got a smile on my face today.
I bet you do. Yeah, they played a great game and totally deserve it. So they're my second favorite to win. I'm actually Vegas Knights. So, you know, my Ducks gone in round 1, pretty quickly disposed of. So I had to move on. Vegas, baby.
The only problem I have with Vegas, I mean, I'm happy for them. They got their new franchise. Everything's looking good out there. They're heading for their first conference championship in their first year. I mean, it's really pretty amazing. But as a Capitals fan, I have suffered for so long to have an expansion team come in and win the
Take
cup
it.
here. Are you kidding me?
Well, we better get on with the show. I know that we're part of a minority, I think, that watch hockey. Actually, we'll have to do a poll one day. That would be kind of interesting, wouldn't it? To see how many people even care. From surveys, I know that not everybody does.
Yeah, I'm sure that it would be like, hey, just get on with the market, please.
Yes, I know, but we have to get ourselves all ready. Okay, so what's going on this week? We have Jeffrey Sopp from Raymond James, and he should give us a really great presentation. Dan Russo from Chaikin Analytics will be with us on Thursday, and Friday we have Everything Stock Charts. We'll have to see what they have in store for us Friday. But for today's agenda, we're going to start off with Tom's workshop on shorting very soon. 10 and 10 to 1, our first symbol is going to be Kemet Corp, KEM. And we will finish up with a ChartWatchers review. I'll go through some of the interesting information you don't want to miss that came out in ChartWatchers. So hang in there for that, and let's go ahead and get it going, Tom, with some technical news and headlines.
All right, sounds good. First, we always like to start off with 10-year Treasury yield. There was no economic news out this morning, at least nothing significant. And so the bond market, kind of just trading off of technicals today. And currently those technicals do remain bullish, meaning that the yield continues to be in this uptrend. That typically coincides with solid market action in the stock market as well. There is a pretty solid positive correlation between the direction of Treasury yields and the S&P 500 over fairly short periods of time. I know I've had questions of, whenever I bring this up, then someone will say, well, how come interest rates, Treasury yields have gone down for the last 25 or 30 years and stock market's much higher? Well, it's not that kind of a correlation. We're not talking about long-term positive correlation. We're talking about short-term. The reason that yields can go down over a longer period of time with the stock market going higher is that new money is coming into both all the time. So it's really the short term, it's the rotation between the bond market and the stock market that we really want to pay attention to. And that's why in the short term, when bonds are selling off, that money coming out sends Treasury yields higher, and that money also usually flows over into the stock market to send the stock market higher. That's why in the near term they tend to move together. So we do have the 10-year Treasury yield moving higher. So we shouldn't be too surprised or shocked that financials are also moving higher. They tend to do very well, especially the banks, when we have a rising Treasury yield. And that is the case today. You can see coming off the recent lows, the XLF, we just talked about this one, I think, yesterday or the day before. Well, it wouldn't have been the day before, but it would have been yesterday, I guess. We did put in a nice reversing candle, a nice hammer right on support on the XLF. We bounced off of it, had a bullish engulfing candle the next day, and we are continuing to move higher. I wouldn't take too much bullishness from the fact that we're trying to get back through the 20-day moving average. Again, when you sideways consolidate, I really don't pay a whole lot of attention to the moving averages. I'm much more concerned with key price support, which I think is pretty clearly around 26.75 on the XLF, and resistance. You've got price resistance at 28.25. You've got gap resistance up here at about 28.35 or so. If we can clear that to the upside, I think things would start to improve quite a bit for the financials. Also, industrials. I mentioned a few of the individual industrial stocks at the open of the program. You can see the XLI also having a very strong day. In this case, after trending below the 20, we're struggling a little bit. But like the financials, again, I think the moving averages do not present the same support and resistance during consolidation that they do during a trend. So I would be careful about reading too much into the 20-day moving average here. Instead, I would be looking at this nice reversal that came in and the fact that we are now up for the fourth straight day in the industrials. A strong finish would be very bullish here. A few of the stocks that I mentioned. First, General Electric. At the open, I talked about GE, the best stock in the Dow today. You can see the GE coming up, actually gapped up with its earnings back in the third week of April and went back, filled the gap, hit the moving averages, and it's starting to turn back up off of this. This is, I think, and I've said this recently, I think the GE is actually performing much better technically than it has in some time. I'm going to annotate this really quickly because I do think that we are in a possible bottoming head and shoulder pattern. I would prefer if I always like to see a little bit of a rising neckline. And here, if anything, maybe we have a little bit of a decline, especially if we use intraday information. But it still sets up to me what could be a bottoming reverse head and shoulder pattern where we come down, put in the left side or left shoulder, move back up to the left side of the neckline, move back down one more time to put in the reverse head. And notice on this reverse head, the volume that came in right at the end, I would say is even, a little bit below average volume, which is what you want to see. It seems like the selling is drying up. Then all of a sudden, instead of putting in lower lows and lower highs, we make a move back up on heavy volume, challenge that prior high, which I think is a good thing, pull back, and now we're hitting a rising 20-day moving average instead of always coming up and testing a falling 20-day moving average. So you kind of see how the chart's been flipped a little bit. I think if we get a breakout above 15 on GE with some increasing volume, I think we could have put a bottom in, at least more of an intermediate term bottom. But something to keep in mind. A couple of the other stocks in the space, Expeditors, EXPD, also having a very strong day, breaking out above some key resistance. Now, if we were to go back down and close below, say 67, you can see these tops coming in around 67. When you get that false breakout and leave a tail up there and come back down and fail to hold it into the close, it can signal some short-term selling. So I like what's going on here. I love that big volume and the spike to the upside, but we did not open at breakout territory. So if we leave a long tail up to 70, come all the way back down, close below 67, this candle would not be nearly as bullish as it would be if we close at or near the high today. So Expeditors will be worth watching. Again, this is one of the better performers in the S&P 500. Next up, JEC. This is Jacobs Engineering. I like what's going on here. We were moving down. We came back up. See how we got, again, off of this downtrend, lower lows, lower highs. We come back up and we test the upper end of this range, come all the way back down, put in a double bottom. I think a breakout above 61 would be very bullish. Now, currently, similar to what we were just looking at on EXPD, we do have a breakout, an easy breakout earlier today up above 62. Now we're pulling back. It's a little bit sketchy at this point whether or not we can hold the 61 level into the close. If we fail and put in something like a shooting star, my guess is maybe we'd go back, hit the rising 20-day moving average, and then turn back up to the upside. Or if we finish strong, I would expect maybe over the coming days to put in some additional gains. We'll have to see. There was a story out this morning about Snap CFO Andrew Valero. He will be leaving the company. Not too shocking, I would say, after their horrible quarterly earnings report. I don't know if that's just coincidence or maybe the company was asking him to resign. I didn't really look at the article. I just know that the CFO has decided to depart. And this is just 3 months after the company really looked strong, looked like things were changing. If we pull up a weekly chart, that move back in February broke this downtrend that the stock had been under since going public back in February 2017. So we've been drifting mostly lower for a year, and it looked like we kind of turned things around, pulled back, hit price support, looked like it was ready to go, and yet the stock kept going down, and it has broken now to new lows on this latest earnings gaffe. So something to kind of keep an eye on. Now, what I like to do with the market every day, I like to mention this once in a while, is I go into the control center and I like to bring up the sector and industry summary just to see what's going on. So right here, you can see of the 7 sectors, 2 are leading, financials and industrials. Especially I'm interested in watching those financials because the 10-year Treasury yield's on the rise. We hit a major support level on the XLF. And so I'm excited by that continuing bounce. Banks are on top of the financial leaderboard, and that's what I would expect. I know it was just maybe the end of last week sometime, maybe Thursday or so. We're talking about it was intraday when we had a pretty ugly looking candle and we were down near this 455 level, and talked about if you wanted to go into banks, it was a great time simply because if for no other reason, you had a very tight stop that you could put into place. A close below 450, maybe if you wanted to give it a little bit more room, 455, and if you wanted to give it a little bit more room, 450. We went down into that range, printed a hammer, came back up, closed near the high of the day. Just like we talk about, you don't want to leave long tails to the upside because many times that marks a top. Well, when you leave a long tail to the bottom side and put in a hammer, many times that will mark a bottom. And so we have been going up for the last 3 days. I would be watching, just like I pointed out earlier on the XLF. Let me annotate this because I think it's really important that we get through a couple of key levels here. And I'm going to say that the key levels are between about 480 and 485. Today's earlier high was 477. We are testing the 50-day, but again, the 20 and the 50, I'm not as concerned about as I am getting back through 480 to 485. I think that would be a really important psychological level to get through. And with interest rates, with Treasury yields continuing to rise, I think it's only a matter of time before the banks. I've been looking for them to play catch up with the Treasury yields, and I think this is the start of it. I remember we were talking about, I think it was crude oil, and the fact crude oil was moving up, but the XLE was not, and now the XLE is broken out, starting to play catch up. Well, I would be looking at the banks in a similar light. I think that they are now ready to play some catch up. With that, I'm going to let Aaron take over for a few minutes, go over a few upgrades and downgrades.
All right, and you can get yourself all ready for that workshop on shorting. All right. There we go. Looks like we can see my screen just fine. So today we have 1 downgrade and we have 4 upgrades that I'm going to look at. I added this extra chart in here, and I will explain it later. All right, downgrade, XL Group. This is my guess is that it got overvalued. You can see there was this giant gap that came in back in early March, and that was associated with the fact that AXA, I guess insurance, made a play and bought them. So that raised their price. So you're seeing, though, we've been in this trading range ever since. Of course, we dipped down, test that 50-day, and are now at the bottom of that trading range. I think there's some opportunity here, but not a whole lot. And I'm going to move this into a 2-hour chart over the last 2 months, I guess would be 3 months. Oops, not years. Sometimes if I just can't see enough information, I want to move into something better. Okay, we need to go more like 2 months. And I'm going to make my bars a little thicker. There we go. So now we've got a little bit better understanding of what's been going on when we look at a 2-hour chart. So you can see that at this point, it's trading under the support that we had earlier at the end of April. We haven't gotten back above it. I think what I said is there is some opportunity only because we are sitting down here on this support level, the bottom of this trading range. So there's opportunity to move it up. But, you know, we're talking about a $1 move. I don't know. I mean, it could turn out to be a good play here, but something to consider. And I did want to show you that as far as it did get the downgrade. So we'll have to see. It's holding that support. All right, so let's look at some of these upgrades. AAP Advanced Auto Parts, sitting up right against overhead resistance. And I found this for some of these that we were looking at. Notice in the thumbnail, though, we have, we had the worst configuration as far as the EMAs earlier at the end of April. But you can see as of early May, we got them all to cross over each other. That put me in a buy signal for all of my trend models. So I would expect to see it break out above this overhead resistance, but the problem is there's some lurking just behind that at 125. So not so sure I think there are better candidates, but that's an interesting one to look at. Let's go ahead and look at Louisiana Pacific. This one, I think there's some potential, but we need to get back up into this ascending triangle. It's not a classic pattern in that we did break down and it did sort of nullify the actual pattern, but I think it still gives you an idea. We need to get back above that rising bottoms trend line. We've got overhead resistance sitting here at 31. I'd like to see this PMO start turning up, but we're seeing a bad OBV. We're seeing a bad scooter going on, but we found support on the 200. Again, I think there are better opportunities out there as far as risk and reward, even if you wanted to go in this trading range here. So I thought that was interesting to talk about. Northrop Grumman also got an upgrade today. Another one where we're seeing a bounce off of the 200-day EMA. And so I think that bounce off of that support level and the 200-day EMA is promising. And in this case, you can see the PMO is actually decelerating, considering turning up, and you've got a scooter that's now moving in the right direction. So I think this could be an interesting play, but again, you have to pay attention to where the next area of overhead resistance is. It doesn't lie too far ahead, but if we can get over that, then you've still got to ride up here to the top of the trading range. So could be an interesting play. This is the other one, IQ. So I pulled up this daily chart, and yeah, there's not much for me to talk about here because there's not enough data. So what I opted to do was similar to what we did with XL Group, is I went into this is a 60-minute chart. And this pretty much gives us all of the trading activity that has so far occurred. And it really opens up the picture for us. So just remember, though, we're looking at a 60-minute chart. So anything you're looking at as far as trading off of these technicals, you need to pay attention to the fact that this is a 60-minute chart. So you're trading time frame is going to be a lot smaller if you're going to be trading off of this particular chart. But I think we're looking at a pretty good setup here, actually. We've got a rising trend channel in play. We just got a 520-day EMA positive crossover. We're on a PMO buy signal. You've got overhead resistance at 1750. But in this case, a move from, 1650 area to 1750, that might be a much better play as far as, getting in and, your risk reward, because I would think you could set your stop pretty much down here where we opened. I mean, we could get down here into the $16 range, and that could be a good stop. But just remember, this is a 60-minute bar chart, so something to consider. With that, I'm going to pass it back to you, Tom, so you can get started on your workshop.
Okay, sounds good. I think maybe what we'll do is start off with a poll. So there was a poll specifically set up today regarding shorting. And I thought it would be good just to have a general sense of what everyone's experience is, or what the overwhelming experience is in the room. And so I see that about half of you that have responded have said you've never shorted a stock, which isn't too surprising. I always think that there are going to be fewer and fewer folks that haven't shorted, meaning that most have. But every time I've done a webinar, I find this somewhat to be true, that the majority, or at least half, have not shorted before. You can see 28%, so almost 80%, roughly 80% of you have either never shorted a stock or you only do it occasionally. Another 10% only short in a bear market. And that's where I would probably be. I can't remember the last time I shorted a stock in a bull market. It's been a long time since I've shorted a stock. But I tend to only short stocks in a bear market. And I don't trade in a bear market on the short side the way I do in a bull market on the long side. I mean, when I'm really bullish, I'm 100% invested on the long side. And I'm quickly kind of running through my portfolio, turning it over, because I do trade pretty often. And then finally, at the end there, you can see I short stocks frequently, 8% of you. So it is a minority. But I get questions all the time, what is shorting? How does it work? And so forth. So I thought what we would do is let me start off the presentation just by giving you a quick analogy that maybe might make it a little clearer. Maybe I'll just muddy the waters more. I don't know. But let me give you an analogy real quick. So let's say that you're home and your next door neighbor let's say you're a car person, you're really into cars, and you see that the next door neighbor has a car, they haven't been using it, just been sitting in their driveway, and you know something about this particular car and the fact that it's going to lose value over the next 30 days. Now, you want to try to profit from that, so you go over, like you're the nice neighborly person that you are, and ask if you can borrow their car for about 30 days. Now let's forget about the fact you'd need their title and all. Let's not get too specific. But let's just say you were able to take their car, borrow it from them for a month. You're going to return it to them, but you want to profit from the value of this car dropping over the next 30 days. So you borrow their car and you take it, and you know that right now is the best value that you're going to get. So you want to sell it now, and you want to buy it back later after the value has gone down. So let's say this car is worth $20,000 today, and you think in 30 days it's going to be worth $15,000. So you borrow their car, tell them in 30 days you'll return it, and then you sell it to someone. You borrow your neighbor's car and you sell it to a third party for $20,000. 1 month later, that car, just like you thought, drops down to a $15,000 value, and you go back and you buy the car back for $15,000 in 30 days, and you take it back to your neighbor and say, here's your car back. Essentially what you've done, you never owned the stock. It wasn't yours. You were borrowing a neighbor's car. You went out, you sold it, you made $5,000, bought it back $5,000 cheaper. So you've pocketed the difference, and now you've turned it back over to your neighbor. Your neighbor doesn't know any different, right? I mean, you just borrowed their car. They didn't know what you did with it. And then you returned it, hopefully in the same condition. That's essentially what you're doing with shorting stocks. There's so many stocks. It's a little easier just thinking about one car, and that's why I wanted to use the analogy. But think about all the shares of stock that people own in all the different brokerages around the world. Essentially, what you're doing when you're shorting is you're borrowing someone else's shares and you're selling them to try to profit from a decline in price. You're going to get your target, you're going to sell, you're going to make your money, and then you're going to turn your shares back over to the person that you borrowed them from. Now, the brokerages take care of all this for you, so it's not that not that big a deal. All right. Now I'm going to go into a few terms and some of the risks that are involved in shorting. For right now, I just want to, well, maybe I'll pull up a chart in just a minute. There's the analogy. I'm going to go into the key terms and risks. After that, we'll talk about considering the odds. You know, I'm a historian. Run some scans that I would set up in a bear market, and then talk about reward to risk setups from a shorting perspective. So that's kind of the layout that we're going to go through and talk about today. So let me go through some of the terms and risks. And I think maybe what I'll do first is just pull up a chart of, I don't know, maybe say Apple. And at least give you something to look at while I'm discussing a few concepts. So when you short, shorting or short selling, that's when an investor borrows shares, immediately sells them, and then hopes that he or she can buy them back later at a lower price. After all of that takes place, then you take the shares, you return them to the lender, and essentially you're pocketing the difference in price. You're making money when that particular stock that you shorted goes lower. So you borrow someone's shares, you sell it, the price drops, you buy it back at a lower price, and then you return those shares. That's how, in theory, it's supposed to work. Now, there are a lot of risks, and we're going to talk about that in just a minute. But before we do, I just give you one or two more terms. When you buy back your shares, sometimes you'll hear someone say that you're covering your short, or that you're covering. Essentially, what you're doing is you're buying back that short position. That's what covering means. Now, the investment risk of being long, not short, but long, your investment risk is whatever you invest. So if you say, I want to get into Apple and I want to buy 100 shares at $185 or $186, my risk is $18,500, roughly, maybe $18,600. That, if the worst case scenario happens and I don't know, Apple computers start blowing up and, start taking out countries, and all of a sudden Apple stock goes to zero, the most money you can lose is $18,500. One of the problems with shorting, let's say you look at Apple and you say, wow, it's moved up way too much, too fast. I want to short the stock. I think it's going to pull back $15. And when it does, I want to make that $15. Well, what you would do is you would short Apple. So you would sell short with your broker. And so the broker would borrow someone else's shares and allow you to sell them. And then if Apple pulls back $15, then you would buy them back, and you would essentially be returning those shares back to the broker. And you would then make money. You would sell at 185 and you'd buy it back at 170. So instead of buying at 170 first and selling at 185, you're just doing it in reverse. You're selling at 185 and then you're buying back at 170. Hopefully that makes sense. Now, that's perfect if it works out well. But what happens if Apple, they just came out recently, or Warren Buffett just came out and announced that Berkshire Hathaway has bought 75 million shares. What would happen if that announcement came out right after you shorted and Apple, takes off $20? I mean, we've had a huge move up with earnings and with that announcement. But Buffett's been talking about buying Apple for some time, that he was getting into Apple. But anyway, the point here is that if you short at 185 or 185, so now you're short, you've essentially sold the stock for $18,500 if you short 100 shares. The question is, how much risk are you taking on this? Because now all of a sudden your risk is to the upside, not to the downside. How high could Apple go? Well, you might say, well, it's $930 billion company. It can't go that much higher. Well, not too long ago, it was $200, $300, $400 billion company, and it got up to $930 billion. Who's to say it's not going to be a $1.5 trillion company in a year or 2 or 5 years? So are you going to short and hold on to this thing long term, or is it going to be a trade? The thing you have to realize with shorting is that your risk, your unlimited risk, is to the upside. So when you buy a stock, you know what your downside risk is. It's how much you invest. Your upside is unlimited. With shorting, it's the other way around. With shorting, the most you can make is 18,500. But if the stock goes against you and you think you're just going to hold on to this stock for a long time, you know, and wait until it collapses because you just know Apple's going to be a bad investment, that can get really painful over time. Take a look at a 15-year monthly chart on Apple. Pull this up. Now, what would have happened 15 years ago if you decided, you know what, Apple, I just don't get the hype on this company. I'm going to short it at $1 or the equivalent of $1. Obviously, it didn't trade for $1 back then. This is split adjusted. But let's just say that it traded for $1 and you decided you wanted to short it. Well, if you had to cover today for every dollar that you shorted, you'd have to cover $185. And you think, well, you know, that's not really possible. There was a story recently. A company came out, an individual came out and shorted 37,000. I didn't even pull up the ticker symbol, but shorted $37,000 worth of a stock KBIO. I don't know if that's, let's see what we have here. No, it's not going to come up. Well, I think it got bought out. I think what happened is stock got bought out. That's why it's not showing here. But literally, someone invested, they didn't invest, but they shorted $37,000 worth of KBIO stock. The next day, another pharma, that CEO gained control of KBIO shares, and the stock, KBIO stock, went up 800% the next day. Now, you can do the math if you'd like, but $37,000, and all of a sudden, if you make 800%, you're going to be pretty darn happy. But when you get caught in a squeeze like that, the investor said he got caught. The broker couldn't get him out of the shares because this thing just shot up, ended up wiping out his and his wife's entire 401k in order to cover. And I mean, this I thought was kind of bold, but he started a GoFundMe page. And you can imagine what other investors thought of that. Didn't get a whole lot of contribution. Let me just say that fundraiser didn't work out very well for him. But that is a risk. When you're getting in on the short side, you have to understand your risk to the upside, or in this case, the downside, is unlimited as a short, you know, when you're shorting. It's unlimited to the upside when you're long. It's unlimited to the downside when you're shorting. A couple other things you might not realize about shorting. If you short a stock that pays a dividend, you're paying the dividend. A lot of people don't realize that. So if a stock that you are shorting has a 5% dividend and you go through that whole ex-dividend process, you got to pay that dividend. So it's not just, you know, when you own a stock, you get the return on the stock and then you also get to accumulate the dividends. If you're on the short side, you're on the other side. Keep that in mind. A couple of other terms. Short squeeze. What's a short squeeze? Well, short squeeze is when a stock's price jumps. Let's say, trying to look for something. Actually, let's go to a daily chart on Apple here. So you can see the gap up here. When you get a lot of volume coming in, and you can see, you know, Apple was kind of drifting lower. All of a sudden, you get good news, and you start seeing breakouts and so forth. This is a form of a short squeeze for those who are on the short side. That all of a sudden now you've got a lot more buyers than sellers. You got a key breakout, and many of the folks that have shorted, maybe thinking that we weren't going to go through the 20-day moving average, that we're going to drop back down, all of a sudden now are seeing prices move against them. And so they sold way down here, and now they're going to have to buy back at a much higher price. And you always say, you know, it's just the opposite of when you're long. You know, you're short, price is moving up. It's like, okay, when it pulls back, I'm going to get out of this thing. Well, it just keeps going up, and that forces a lot of shorts. It squeezes a lot of shorts and creates more demand for the stock as those shorts have to run for cover and run for the exit, basically, and get out of that short position. So keep in mind that short positions do at some point create demand. You have to buy those shares back at some point. How about short interest? Short interest is the total number of shares of a particular stock that have been sold short by investors but have not yet covered. You can see it as it can be expressed as a number of shares, or it can be expressed as a percentage of those shares relative to the outstanding shares. Short interest ratio. This is where you take the number of shares sold on a stock and you divide it by the average daily volume. It's also referred to as days to cover. Many of you may be familiar with days to cover ratio. The higher the ratio, obviously the more impact. If you start to get a breakout, the squeeze could be even triggered much more, much more from a breakout standpoint. You could have a lot more buyers coming in to fuel that rally. Let's see, what else do we have here? Now, one of the things I ran into when I shorted, I had multiple brokerage accounts. I would go into one account, like say Scottrade, and I would try to short a stock, and they'd say no shares available. And then you run into that quite a bit. And then I would go to Schwab or to TD Ameritrade or E-Trade or something like that, and I'd be able to short. So some brokers may not have the shares available, while other brokers do. So if you're just trading at one broker, you could run into some difficulties there. It gets very frustrating when you find a great looking chart and you're like, wow, I just want to short this thing. You go to your broker and, oh, we don't have any shares available. That's frustrating. You also have to be careful with the small cap shares that don't have as many. Sometimes the short squeeze can be much worse on a company that doesn't have as much volume or as many shares outstanding. First of all, you might have problems finding shares to short. But then if you do get into them, you got to be careful because sometimes that short interest is higher on small cap shares where there's not as many shares outstanding. So you just got to be careful there. Now, what are some of the risks of shorting? Well, first of all, and this is probably the biggest one, the overall stock market can just go higher. We're in a bull market. One of the reasons why I won't short right now is because we're in a bull market. The bull market's continuing to go higher. I know we're consolidating right now, but I believe the market's going to go higher. So I'm not interested in shorting because if the market does go higher, the odds of me getting the right stock and being in the right position for a short, those odds are just not as great as when you're in a bear market or when you're in a consolidation mode like we've been the last few months. How about company becomes a takeover candidate? We've seen that before. Stock is under pressure for quite some time. Chart looks horrible. And then all of a sudden the company comes out and sees the value and says, well, we were looking to take over. You know, we're bidding X dollars per share or whatever. So you can see a huge jump there. Company just announces good news. All of a sudden, big earnings surprise. Maybe they just hired a CFO from another company because they fired their CEO. We've seen this before where a company not doing well fires their CFO or CEO and the stock jumps. And, it's a nice little parting present to the executive that's leading. It's like, thank you very much for your service, and the stock appreciates you leaving. Well-known investor announces a position in the stock. Take Warren Buffett, what he just came out and said, Berkshire Hathaway just bought 75 million shares of Apple. Market loved it, jumped up. So you could have something like that happen. There could just be a positive development in the industry, in a company's industry. Or how about legislative changes or political changes or geopolitical tensions that might improve or alter a company's prospects. Lots of different things can happen. And of course, if you're on the short side, you're subject to unlimited risk to the upside if the market continues taking off. All right, I mentioned the odds. Just consider for a minute that since 1950, the S&P 500 has moved up 53% of the trading days. So by simple math, it's gone down 47% of the time. On the NASDAQ since 1971, the NASDAQ has risen 55% of the trading days. It's gone down 45% of the days. So just from that perspective alone, the market goes up more than it goes down. That's a risk of being short. Okay, let's keep moving on. I want to get into a couple of, one scan in particular. So I'm going to go back to the main page here. And there's a lot I could talk about with shorting. I mean, I didn't get into margin requirements. There's a lot of different options. I mean, just to short would be very risky, but there are option strategies that can lower the risk. It's like, if you're on the long side, you have a covered call strategy. that, you know, a lot of folks think of options as being risky, but sometimes they actually do lower your risk. And so there are option strategies relating to shorting that can help. But, you know, we could get into that. I'd be talking for a lot more than 30 minutes. Anyhow, let's move into running scans. So I did set up a scan. Now, we're not in a bear market, but if we were in one and I was looking to short, I would be looking at this short scan that I set up. So let's edit the scan. Now this is the basic workbench. Let's see, I could move it over to the advanced scan workbench. For those of you who are more familiar with this, you can kind of look to see how this is set up. But essentially what I'm doing is I'm looking only at the S&P 500, first of all. I'm looking at the 20-day moving average, or actually the 20-day moving average of volume being greater than 40,000. Well, that's not a problem with the S&P 500. They're all going to be greater than 40,000. The RSI is greater than 55, but it's less than 60. Now, think about a stock that's downtrending. When it's in a downtrend and the RSI gets back up close to 60, that tends to be a cap. Just like when a stock is uptrending, when it pulls back to 40, I've talked about that many times on the show. I like RSI 40 as support. Well, in a downtrend, I like RSI 60 as resistance. So this is giving me stocks that have RSIs between 55 and 60. And then finally, and this one's important, the 20-day moving average is below the 50-day moving average. So in an uptrending stock, the 20 should be above the 50. In a downtrending stock, a lot of times you'll see the 20 below the 50. So I've got the 20-day below the 50-day moving average and the RSI between 55 and 60. So in other words, a downtrending stock, but it's probably bounced. And this is a scan that I would run. So if I run this scan, currently on the S&P 500, it brings back 22 stocks. So I thought what we would do is maybe look at some of these and consider how we would set up a reward to risk on the various stocks. Now, I don't know if we'll have time to go through all 22, but let's take a look at a few of them. Here, the first one is Autodesk. All right, now if you're looking at Autodesk, first of all, you can see the 20 is just crossed below the 50, but it's starting to turn up. And Autodesk, you know, many stocks are going to be in uptrends over the longer term, but clearly Autodesk has been in an uptrend. And when I look at the weekly chart, the last big move up here to open up March, you can see the PPO coming up off of centerline support, moving higher. We're holding the rising 20-week moving average. When I pull this up on the longer term chart, I don't know, I'm not very interested in shorting the stock. If I looked at it solely from a daily perspective and I said, okay, I have to short this stock, where would I short it? I would be looking at price resistance. And I would probably go up here. You can see we had some selling, we bounced back up, and then volume here picked up pretty substantially on the selling from about 135. Notice on the recent high, we went right up to 135. So if we had seen this before and we were looking to short back in the third, fourth week of April, you could get into a short position near 135 and simply cover your position if it goes to 136 on a close, or intraday if you want to really keep it tight. You could just say if it goes over 136 intraday, I'm out, covering my position. But what I'm looking for is for the stock to move back down to the prior low. Well, this is setting up a really strong reward to risk from a shorting perspective. You're at resistance, at least the resistance that you're picking out, and you're setting a stop to say if it goes back through, say, 136 or so, I'm getting out. My target's going to be the prior low, which it hits about 5 or 6 days later. So what happens in this case? You sell short at 135 and you buy back those shares at 122. You make $13 on the trade. Your entry was at 122, so you're making $13 on a $122 stock, a little bit better than 10% in 6 days. Not bad action. Now, as it's moving up again, and I am not advocating shorting any of these stocks, by the way. I'm not a fan of shorting in a bull market. I still think we're in a bull market. But for those interested, I would just say manage your risk similar to how you would manage your risk on a long trade. So you're looking at resistance as where you might want to sell short. So if I was looking at a long, being long, I'm looking at this support level to buy, and then I'm going to sell when it gets up to resistance. From a short perspective, you're looking at the opposite. You're going to short, you're going to initiate the transaction by selling short when it hits resistance, and then you're going to buy those borrowed shares back when hits your support, and then the broker is going to take care of all this stuff for you. It's not like, you have to go find whoever you borrowed the shares from, like the example I went over earlier with the car in the neighbor's driveway. You don't have to do any of that. All of that's accounted for by the market, by the brokers. You're simply selling first, buying back later. Again, the risk, what if news comes out? Let's say you short at 135. It's no different really than being long, except that on the short side, you have unlimited risk to the upside. But let's say Autodesk, you hit resistance. You're like, this is it. This is a great spot to get in on the short side. I'm getting in, selling short at 135. Next morning, you wake up and Autodesk has been bought out by a company that's trading at 175 next morning. Well, you can't get out at 135, even though your stop is at 136. Sorry, but the stock is now trading at 175. So now you're buying at 175. You sold at 135. You just took a $40 loss on the stock. So it's no different than anything else. If you're holding overnight, news, anything can happen. Just remember that to the downside, you're protected by the amount that you're investing. To the upside, there is no such protection. And in fact, if the losses are great enough, you may be getting a call from your broker saying, okay, you don't have enough in your account based on margin requirements. You are going to be forced to sell. You're going to have to sell this, or you're going to have to deposit more funds in your account. It can get really, really disheartening, very risky. So just understand what you're doing if you're shorting. All right, so that was Autodesk. Let's take a look at a couple of other stocks here, and then we'll wrap up. Let's go to the next one, Align Technology. I know longer term, this has been a pretty good one, but short term, we did have the gap down after earnings, been sideways consolidating here for a while. So very similar to what we were just looking at on Autodesk. Let's say, we were looking to short. We had this big gap down, went down for 5 days, and then all of a sudden we get this big recovery and we're at gap resistance. And this is the level where we deem that, hey, if it goes through here, I'm going to get stopped out. But I'm going to short it at 265 or 266, and I'm going to ride it back down to gap support or to prior price support, whatever it is that you're looking for. Hopefully you get out, you buy back at that lower price, and it comes back up again. Maybe you can short it again. But literally what I do when I'm shorting, it's almost like I turn my computer monitor upside down. So instead of waiting for pullbacks to support, to buy, and then waiting for a move back up to some resistance level to sell, it's the exact opposite. You're selling first when you're getting close to a resistance level, and then you're buying back at whatever predetermined target that you're looking for, maybe in terms of price support, gap support, trend line support, moving average support, whatever it is that you're looking at. Let me do one more, and then we'll wrap this thing up. We'll just, let's, actually, MICROCHIP came out with earnings this morning. Let's see what we got here. Okay, it's up. But this is another one. Maybe you're looking at MICROCHIP, and you said, well, the semiconductors have been struggling a little bit of late, getting a little bit of a move to the upside here. We got reaction high off of this selling. Comes back up here just above 90. We get up there earlier today. The 50-day moving average is sitting there. This is an area that I want to short. So again, you're going to keep a fairly tight stop, sell short at the 90-91 area, and then you're looking maybe to profit from a move back down to 82. If it goes back down to 82, you're going to cover there. That's where you're going to buy. So you will have bought at 82. You will have sold at 90. You'd have made $8 on that trade, or roughly 10%. So essentially what you're doing with shorting is you're just profiting from stocks going down as opposed to profiting from them going up. And so with that, let's go ahead and wrap up. We can maybe take a look at the final summary slide again, things that we covered. And then also I'd like to pull that poll up one more time and take a look at that before we move on to the 10 and 10. So pretty interesting. Well, there's the poll, and it's still fairly similar to what we looked at before. I think another 70 people or so have responded, but still about half of you have never shorted a stock. It's I think for the most part, that's probably best because there are risks involved. I know if you've talked to somebody who's shorted, I'm sure they have stories of how they've made a lot of money shorting, but there is risk. There's a lot more risk in shorting than there is in being long, and you have to be aware of those risks. You have to be aware of a lot of things. You got to do your homework. I think that example I gave you earlier where an investor tried to short $37,000 worth of a pharma, and next day, essentially, it was revealed that another pharma, the CEO, was accumulating shares and gaining control, and the stock went up 800%. And there you are sitting there with a short position. Can be extremely risky. You want to make sure that you understand those risks before investing. All right, and that's basically it. That's what I had for this segment. And so I guess now we will head into the 10 and 10.
Yes, definitely go check out the question room later in the show if you can. I know there were quite a few. I think most of them were saying, as far as shorting and the risk involved, a lot of people prefer to do puts and play the options just because you have some limit on your losses. So, I don't know. You do have to have a margin account to short. That was one I know.
Yeah.
Yeah. Anyway, that was excellent. I really liked your analogy. I think a lot of people probably had a better understanding as well. So, but with that, let me go ahead and get our 10 and 10 stocks up here for you.
Sounds good.
All right. And our first one will be KEM. We had 38 symbol requests today. So, 3/4 of you are probably not going to be too happy. I thought that I would pull it up really quickly in an RRG, just so we can see what's going on as far as the shorter term is concerned and the rotation that is going on. I'll make that shorter and then fit. And now we have a little bit better picture of what's going on. So, the ones we want to look for are going in the northeast direction. So I'll be looking for some of those, but I do like to mix up our sectors. And do go vote, because you, if you want to get a certain symbol request in that someone else has done, go ahead and vote for it, like it, and it'll be the next one. So let's take it away.
All right, sounds good. Let's take a look first at KEM. I pulled this one up on a weekly chart. You can see that we really saw some struggles back in the fourth quarter of 2017. And we've been going sideways. Clearly, a breakout above $20 would be bullish. So we got a little bit to go there. But I wanted to go back and just kind of look at what the stock had been through in 2017, because as it was moving higher, and you can see a huge move to the upside. And then as we broke to new highs in May of last year, we had lower weekly PPO readings. So we had a negative divergence. And yet we never went below the 20-week moving average, and we just kept moving higher and higher. I mean, when this negative divergence printed, we were at $14. 4 or 5 months later, we were at 28. And so an obvious question would be, well, why didn't the negative divergence work? And it's why a lot of folks don't believe in technical analysis, or some folks don't believe in technical analysis. Well, first of all, there is no signal that is going to work 100% of the time. That's number one. Number two, I don't use negative divergences as a sign of slowing momentum when stocks are breaking out with heavy volume like it did here in May. This move up to take out that prior high was on very heavy volume, where it traded almost 5 million shares that particular week. And when you look back, that was strong volume for KEM. So I just find it very difficult to argue that a stock is losing momentum when it's trading on exceptionally heavy volume and breaking to new highs. This is a mathematical calculation. This is your eyeballs looking at it and just common sense, seeing higher volume and a move to the upside. To me, that outweighs a mathematical formula, which cannot go up. I mean, they're not bound in a sense. The PPO can continue to go higher, but the move to the upside, that slope has to continue to really push to the upside for the PPO to continue rising. You will get negative divergences at some point. Now, where I start getting a little bit more concerned is when you have higher prices, the PPO is lower, and then you start putting in these reversing candles with heavy volume on the selling. Then that starts to tell me that maybe we're getting closer and closer to a top. And so anyway, KEM I thought was pretty interesting in 2017. I just wanted to kind of work through this, but notice after the negative divergence, we did go get a 50-week test. We did go all the way back down to the center line, and now we are just simply consolidating. My guess, I don't have Bollinger Bands up, but my guess is they probably have narrowed considerably, and we're waiting for a big move on KEM. I think a breakout above 20 would be bullish.
Okay. And it looks like our next one, it was actually a tie because the person asked for two stocks, Nvidia and Adobe, but I know we did Adobe yesterday. So let's go ahead and do Nvidia.
All right. Seems like we did Nvidia as well, but I don't think it was yesterday. I don't remember.
Well, anything that gets voted in gets to be second, even if we do it every single day.
There you go. New rule, Market Watchers Live. We got this rule established. Okay. All right, you've got some key overhead resistance on Nvidia. I think if you look back, you can see that we've really struggled once we've gotten just above 250. And yesterday and today, we've got highs just over 250. So we're at a key resistance level. This, from a trading perspective, would be a sell area for me because I don't know if it's going to go through. If you waited back here in mid-March for the breakout, you would have been waiting. You still would be holding the stock. And you would have to suffer through quite a bit of selling prior as well. But I think your key support here undeniably is down around 214, 215 with this double bottom. Resistance is at 252. That's the trading range for me for now. I do expect that Nvidia will break out. I think the long-term uptrend followed by this consolidation is bullish, but whether it breaks out now or whether it waits another month or maybe not until October, who knows? But I do like Nvidia. I think it's in a bullish pattern.
Okay. The next one I have for you, let's see, it's from the technology sector, and it's the only one actually, we have a ton of those as requests, but it's the only one that's in the weakening category. All the others are in the leading category. So thought it might be interesting to look at that, given that it's saying it's weakening.
Which stock?
Oh, I'm sorry, ALRM, Alarm.com Holdings.
Yeah, they just reported earnings. This is one I was watching recently because they came out with earnings. I was studying the earnings. Had a nice gap up, pulled back. I think eventually we're going to get a push back to the upside. I'd like to see a long tail to the downside with a recovery, maybe a move down to 38, come back up, close above that 50-day. That might signal it. But I believe this one is in the software space. And when you take a look at the highs coming across here, you can see that this 40 area has been pretty good. We went just a little bit below it. That's why I'd like to see something that really shakes the stock out and then reverses back. I think it's got a good chance, though, to head back up to about 43.75. Another stock that did something very similar to this recently was Juniper Networks, where you had the big gap up, had a huge black candle, came down for a day or two, and then we've started working our way back up. I would look for something similar here on ALRM.
Okay. Let's see, the only consumer staples stock, CVS Health Corp.
All right, CVS. I remember looking at this recently. Whoops, CVS, not X. Yeah, I'm trying to remember what I was looking at on CVS. I think it may have just been the drug retailers in general. It's probably here over the last week or so, we're having a bad day, probably as a result of what's going on here with CVS. We are getting near support, so it's a downtrending stock, but if I had to trade it here, I would be on the long side, only because we are so close to support. So we've got resistance now, I think, established up here around 70, support at 60. You could get in, have a fairly tight stop, and with a considerable reward to risk. The only downside, I shouldn't say just only downside because it's kind of a pretty big deal, is we have been downtrending since the high in January. And from a relative perspective, this is a stock that's been badly underperforming the S&P 500. But again, you are at support, so if I had to trade, it would be long here.
Okay. The next one is for our Canadian friends, and it is the only utility sector symbol requested, and that would be AQN.TO, Algonquin Power and Utilities.
All right, another one that's been, moving lower for the last several months, and I think now consolidating. Maybe this could turn out to be a reverse head, but the pattern still has a lot to do to evolve. That would be a potential neckline. So you come down, you put in a left shoulder, Here's the bounce to put in the left side of a neckline. Here's the lower low that establishes the head. Less selling here on this move compared to what we saw back from that left side of the neckline or potential neckline. So it looks like maybe the stock is running out of sellers, and now we're moving up. You can see the PPO has gone positive for the first time in 2018, and we did have a successful test of the 20. So there are some positives here, but I would be looking maybe at this pattern. I don't really like the stock until we get a breakout above 1310 with some increasing volume, but it is one that I would keep an eye on. It's a very interesting pattern.
Okay. I'm thinking you might like this next stock symbol. Acushnet Holdings, their symbol is GOLF, G-O-L-F.
Whoops, I can't get my typing here. Right, great. Golf. Yeah, that's a great symbol. Always a great symbol.
Recreational products.
Yeah, I don't like the big gap down here, but it did hold support. So I'm still okay as long as it doesn't close below 22 or even maybe just a tad under 22. You can see the highs that were established back in January, came back up, put in a double top, pulled back a little bit, hit the moving averages, and then volume expanded as we went through, which I like to see. So the selling that we saw just recently went all the way back down, tested the area of the breakout, printed a hammer, and now we're moving back to the upside. I think we're in a range, though. I think that off of this uptrend, I would look for this range to continue. So I would have patience, and I would try to buy it as close as I could to 22 and keep a fairly tight stop, with my target being 24.5.
All right. Another popular request, Valiant Pharmaceuticals, VRX.
Yeah, this one was a wild stock for a while. I haven't watched it recently. Oh, big gap today. I don't know. Maybe there was news out on the stock today. I haven't seen it. If it is, 37 million shares already traded today. We are just a little past the halfway point of the day. So this is going to be the heaviest volume that we've seen here over the last 6 months, which is awesome news. I think you got a couple levels to watch to the downside on a pullback. The closer it would get to these levels of support, the more interested I would be in the stock. So here was that reaction high we saw back in February, drifted a little bit lower here, but now with the big volume, we've gapped up above. Now, that candle is kind of sending me mixed signals. The fact that it's not really continuing higher from the open. It opened at 2010 and it's at 2024 with an intraday high of 21.28. So there was a lot of interest early on, but we've pulled back on very heavy volume. I think if the candle were to end like this, my guess is that in the short term, we might see a pullback to, say, that 19 area. And I think 18 to 19 would be an accumulation zone, especially with the rising 20-day coming up from underneath. That's been holding for the past 4 weeks or so. So I think the 18 to 19 area would be the best entry for me. And ultimately, given the breakout, I would be looking for it to move up to the 24 area.
Okay. From the mortgage REITs industry group, we have Starwood Property, STWD.
Okay, nice breakout, and the volume is there to confirm it. So I like the stock. I would simply say that right there is your breakout level. There's the breakout candle, and the volume, I think, is pretty strong, as you can see. So right here is your big volume, and then right here is your rising 20-day moving average. So again, this is another one I prefer on a pullback. If I could get it around 2110, I'd like it a little bit better. This is not a huge mover. So if you're somebody who's really looking for something exciting, STWD is probably not going to be the stock for you. You can see really for the last couple months prior to this breakout, stock traded in about a 70-cent range for a $20 stock. Not a whole lot of, beta is going to be pretty low on a stock like this. So STWD, I think, is a buy, but I prefer it on a pullback to around 2110.
All righty. Another interesting symbol, Brinker International from Restaurants and Bars. Their symbol is EAT, E-A-T.
Yeah, nice looking chart. I think this is on my strong earnings chart list as well. So I really like this company. I'd like to get a pullback. I could own this one on a pullback. A couple areas I'd keep it on a list and watch for. Clearly, the support, if we were to pull back, I think anywhere near 40. I doubt that we would get back that far because I think you're going to find buyers on the rising 20-day moving average. But it could pull back $3 or $4 if things were weak, maybe in the space or maybe the market continues to consolidate. Maybe we move back toward those S&P lows that we've talked about. Could set up a possible move back down. But the rising 20-day, I could also draw in like a little rectangle here for the gap support. I think this was the gap up with earnings. So 42.75-ish is probably going to be a pretty good level of support as well. But I like the chart. I like the fundamentals here, and technicals back it up. So I would be long, but I would wait and see if I get a little cheaper.
All righty, let's see. And last one will be Northern Oil and Gas from the energy space. It's the only one that is starting to be in the improving category, NOG.
All right. Well, the gap up certainly helped. I think we had a downtrend in play. I'm going to look at this one maybe just a little. Actually, let's go see if we can get it on that relative chart. I haven't done any of those today. Okay, so it definitely is in the oil space, which has been very strong. We were good here on this move up through January. And then we pulled back, and you can see that the industry group has broken out to a new high, but we're not anywhere near a new high. So what does that mean? On a relative basis, is a stock that has been struggling, but it's starting to make a move, and that move is coinciding with this gap up to break the downtrend. So I think there's some positives here in that it's in a good area. I do like energy. I think crude oil is going to go higher. And so I think that many of the energy companies will probably catch that current and move higher. You can see that the industry group relative to the S&P has been very hot with this move higher in crude oil prices. So all in all, I kind of like the stock. Now, what I would look for, let me annotate quickly. The gap support level right there at about 175, I think would be interesting. And clearly, we have a major overhead resistance at $2. That's from this gap down. Look at the volume that came in on this gap down. We went from 230 down to under 180 on very heavy volume. And then we also had another huge volume day here on over 15 million shares before we started this reversal process. But I like the overall group, so that's going to make me feel a little bit better about this position. Close above $2, I'd consider a buy. It is a small company, so keep that in mind. Or on a pullback to gap support down closer to about 175.
All right, that I believe is 10.
It is.
All right, good. We both matched up there. Not always the case.
Good.
All right, excellent. So I will have these symbols that you are seeing right now up in the MarketWatchers Live chart list. You can get to that simply by going to our MarketWatchers Live blog from the blogs tab. And it will be right at the top of the main MarketWatchers Live page. So you can get to all of these symbols with those annotations you just saw Tom do at that time. With that, I'm going to grab that screen and talk just briefly about ChartCon coming up. Get over here.
I think it starts like 3 months and 1 day from now.
I know. I can't even believe it. I'm so excited. We will be streaming our conference live August 10th and 11th. And if you haven't registered for this, I suggest you do so quickly. I can tell you we have some amazing speakers. I know Chip Anderson recently sent out an email with the 5 top reasons why you want to register for this conference. So if you haven't checked your email, you'll want to check that out. But the main one is we have a guest list as far as speakers that is unparalleled, I think, with most investment conferences I've ever seen, at least advertised. So you'll have all of these wonderful experts telling you what is going on in the markets, but mainly concentrating on risk and reward. So I highly recommend you go check it out. It is online, so you can easily attend just from your own seat in your office, on your boat, on your in your cabin in the woods. As long as you have Wi-Fi and a device that you can use to see us, you will be able to attend the conference. And of course, you will get the recordings of everything for your own use later. And with that, let's go ahead and move on to our final market update. All right. And what shall we add on the end here? Let's see. Let's do, somebody had requested that ETF. So why don't we put that up there and just see. All right, so as you can see, we are really, it looks like a lot of consolidation going on now, but we are below the trading range that we saw yesterday, and not something I want to see, but in general, it does look like we're mostly consolidating, but we are starting to move down closer to intraday lows. You can see the NASDAQ seems to have found some support here at about 72.30, and we've got the Russell 2000. It's been up most of the day. It really hasn't traveled that far below yesterday's close. And I think you were talking about it, Tom, that a rising dollar will a lot of times hurt some of the larger caps, but the smaller caps aren't quite as affected, so they'll tend to do better. We can see the Canadian markets are down as well, sitting near the intraday lows there at 15,779. We have Treasury yields rising at this point. We're at 2.98. And we can see that with UUP, we've got a gap up on the morning, but it is definitely pulling back, taking back about half of the gains that we saw earlier. We've got commodities lower, but they are trying to make a comeback here. As you can see with US, so really difficult morning. Oil prices just dropped pretty handily this morning. We did see it rise, trying to get back make back some of those losses, but we're just heading right back down toward the intraday low yet again. USO is reading at 1387. Gold is down by not a lot, in my opinion, especially when you see what's going on with the dollar. It's up quite a bit here. I mean, considering it started a lot higher. But we're seeing a recovery here in gold, and we might actually end up on the positive side here by the end of the trading day. GLD is at 124.36. Volatility index, we can see, is rising slightly, but really when we're in a range between 14.5 and 15.5, you're not looking at very high readings. And so even if we are starting to see some movement to the upside on the VIX, not anything to worry about, I would say, until we start getting much higher numbers. FXE, we can see gap down on its way back up. I believe this is the Euro Trust. And you can see it's not going too well. We've broken down below that 200-day moving average. I would hope that whoever requested this is not holding on to this stock, because I don't see, all I see is more downside potential here. I did want to show you, before I end this market update, a chart of the Dow. We did get a new signal change on the Dow yesterday. I ended up, you can see, let's update that. There we go. We got a new PMO buy signal on the decision point scoreboards for the Dow Jones Industrials. I want to show you that particular chart so you can see what we're looking at. So I was not, as I wrote yesterday, I was not completely impressed with this PMO buy signal. It's a bit of a whipsaw signal, but the main thing is I really don't like seeing the fact that price has not been able to get above this declining tops trend line on the Dow. We're looking at an ascending triangle. This is still a bearish pattern. I'm still of a mindset that we're not going to be seeing the best price movement here out of the large caps. I think we can, look at on the optimistic side, probably consolidation. I'm leaning toward that consolidation to further correction mode. That would be my position at this point in time. I know I tend to be a bit more on the bearish side, at least lately. From Tom. That's anyway, that was one of the charts I did want to show you before I ended the market update. And with that, I will conclude the market update, and we can move right on into our final segment on the ChartWatchers newsletter. And mainly, we like to highlight that here in case you didn't get a chance to read it. I want to mainly show you, though, how you can get to ChartWatchers. Number one is you really need to sign up for the newsletter itself. And you can do that at the bottom of pretty much any of our pages right there. So fill in your email address. It is free, as we're showing there. And the great thing is the ChartWatchers newsletter, basically it's out every, let's see, we get, it's roughly every 2 weeks, twice a month. And you can get to those articles from our blogs tab. And here you go. Now, the thing about ChartWatchers, like I said, it is free, so you don't have to be a member. And not only do you get the wonderful commentary from Tom and I, but you also get Greg. Arthur Hill does an article, and John Murphy, and both of these two, I think, are behind the paywall. At least I think Arthur is for one of his blogs. So you're getting free content here from some of the big names on our website. So I would suggest that you check it out. There were a few interesting articles I did want to point out. Of course, John Murphy, I always want to know what he has to say. And you do get the when it was published, and this was on Friday before the end of the market close, which is why he was making note of that. But mainly what he was talking about is that we have a lot of 200-day moving averages. And in most cases, we're seeing bounces off those. And to him, that is a bullish setup. It looks a lot better. We've got technology doing better. And that's led by the internet stocks. And of course, we're talking again about small caps holding up better than large caps. And again, Tom, you're the one who points it out often that the small caps, as we said, might do better with the rising dollar. So we should keep an eye on that. So John Murphy had a great article. I thought that Arthur Hill, he was talking about that we've got these symmetrical triangles, that they can be, they generally are continuation patterns, but they're not always. They can be reversal patterns as well. So he was talking about how we've had this giant advance, that we need to have the big correction. And at this point, he sees that we're going to be into some more consolidation because the market just has to digest all of the, parabolic move and, of course, the reaction correction. So that I thought that was outstanding. Toys, we got a good representation of what's going on in that industry group, especially a few of the ones that Greg thought were looking the best in that particular industry group. And then I did write about my indicators, and I kind of went over these on, Monday. There's that new signal change. Well, that's the signal change we just recently got on the S&P 500. But I did show you how this signal has changed as well. So what we're looking at now is positive momentum on all four of our major indexes. And that's a good thing to see, of course. But again, I'm not really thrilled with the actual market action. So this is a chart that I did on Friday. So what you can do to get to the most recent one is you click on it, and it's going to bring it up in your workbench with my annotations, and we can see what's actually been going on just recently and since yesterday's close. Still having a lot of difficulty penetrating the declining tops trend line. I find that to be an issue, and like I said, that whipsaw PMO buy signal not looking that great. I'd like to start seeing these readings on the PMO start getting the tops moving above prior tops, because you can see we were in a downside movement with declining tops on the PMO. Let's see. So, and then the other things I wanted to point out in particular, I know I talked about our climactic indicators. We had just gotten these very interesting climactic readings. And I was talking about how I was looking at that as a possible buying initiation, not an exhaustion. So what I was looking for was off of this downtrend, we did get the pop. We got the positive readings on breadth. And so in my mind, we were in a declining trend. We've changed the trend. So if I see very positive readings on a move off of a downtrend, I consider that an initiation. So I would expect to see more buying. Of course, I was a little perplexed because we do have a move above that upper Bollinger Band, and that tends to mean that, the next day or two, we're going to see a decline. But I felt that, that was just a tail. I was more impressed by the actual readings. And again, we can come back, click on it, and if we want to see the live version, and there you go. Like I said, my annotations are there. This is something that you can do with any of the blogs. If you like any of those charts, you can click on them. You'll get the annotations. But if you want to save it with the annotations, you need to annotate it. That way it won't, all of those annotations won't disappear on you. So you can just put in something random, just enough to have you save the changes, and then you can save it in whichever list you want to, and it'll stay with those annotations. So highly recommend, if you like some of the charts you see, to go ahead and go in there. You can keep the annotations or not. You can just use the chart style setup, find out how the parameters work. And I mean, that's one of the great things about our blogs, ChartWatchers, of course, in particular, because it is free, and you're going to get the chart setups for all of the big names behind the paywall folks. So anyway, that was what I talked about for myself over the weekend. And then Tom, you were talking again about a rising dollar and the investment strategy. And wow, you get right into the fact that what we want to do is look at the small caps. So if you want to get a little more detail into why Tom is looking at small caps doing better, great article and a super way for you to really get in tune with what's going on. And now notice as well, we have a chart here that he's done where you have correlations on it, you have relative strength on it. And again, if you want this, if you like the way it's set up, click on it, click on the live version, and now you have all of it with the annotations and the chart style setup so that you can set up your own in a similar way. So
the interesting part with this chart is that if you go back toward the top, the U.S. rates are still moving higher. They've broken out. They continue to move higher, faster than what we're seeing in Germany. So this move on the dollar that we're seeing is not likely to stop anytime soon, suggesting that maybe over the summer we're going to continue to see strength from small caps.
Yep, that would make me a lot more interested in UUP as a trading vehicle, I have to say.
Yep, and we are getting close on the UUP. I saw when you were doing the market update, we are getting close to a little bit of overhead resistance on the UUP, but I don't think we might see a pause, but I don't expect it's going to last for very long. And of course, as you've mentioned before, when the dollar is on a tear to the upside, you want to be careful with gold, and it is just hanging by a thread right now at support. So
yep.
something.
There's that breakout on the dollar. I don't know why I didn't buy UUP, especially after it got that breakout I've been waiting for. Certainly a pretty good investment at this point in time. And gold, you were talking about gold. Let's look at that just real quick before we go.
Yeah, we got that support area. You can see it right there. It's just trying to hold on.
1300. Yeah, and I've got the new neutral signal. I've got a declining PMO. It's trying to decelerate off of this bounce here, but if we do start seeing more action on the dollar to the upside, then gold is certainly not going to benefit from that. And part of that is the way they are correlated. And what I've been pointing out and been watching very closely is the correlation between gold and the dollar, and the fact that we are looking at an almost perfect reverse correlation, meaning that if the dollar goes up 96% of the time right now, gold is going to go down. So it's inverse. And so watching that correlation, I think, is pretty key right now. The fact that it hasn't failed here at that support, I think, is somewhat encouraging. But again, I'm bullish the dollar, so I'm going to expect a breakdown on gold. And this signal probably is a warning sign that that we're going to see that breakdown.
Yeah, and what was interesting is even with the dollar tumbling throughout 2017 into early 2018, gold really couldn't get much of a lift. I mean, we saw it move up, but we didn't see it move up faster than the S&P 500, which has been kind of just languishing, even with a dollar that fell about 14% during 2017. So now that the dollar's back on the rise, you got to wonder if gold is going to be able to make that breakout, and if not, maybe move back down toward that trend line.
Yep. Look at that weekly chart, that breakout from that declining wedge, pretty much textbook pattern and execution at this point. So very interesting. You can see the dollar still looks very, very strong. So
yep. And if you go back to that blogs page, you can show everybody how they can sign up for the chart watchers.
Indeed. And like I said, at the bottom of the main page, you can find it as well. Right here on the right side, you can sign up for that free twice monthly ChartWatchers newsletter. And just to comfort you, we don't share any of our email addresses. We don't even share this list amongst ourselves. It's only for the ChartWatchers newsletter. You'll get that and it'll come right in to your email box twice, and you don't have to worry about getting spammed. So highly recommend you do that. And like I said, I think even at the bottom of the blogs page is a way to sign up. Of course, no, there we go. And another way at the bottom of all of our pages is that opportunity to sign up for the ChartWatchers newsletter, which is free.
Yep. If you haven't done one thing at Stock Charts, this is the one thing you do want to do. I mean, you want to make sure that you're signed up, and it would be absolutely the first thing that I would do when you come into Stock Charts is make sure that you subscribe to that, because again, you are getting a lot of information. You're getting something from John Murphy. He's almost everything he writes, I believe. I think everything he writes is behind the paywall. So
absolutely,
this is an opportunity to get his latest thoughts on the market. And I gotta say, he's been my mentor in the market for many years, or at least one of my mentors in the market. I feel like I'm mostly self-taught, but I have followed a lot of the things that John has preached over the years. I completely agree with it. I think he's brilliant.
Yep. And yes, so it is behind the paywall. And Arthur Hill sometimes writes the market message as well, but I know that he has his own blogs. And like I said, I think that his is members only. Yep, Arch Charts. So if you want to get Arch Charts and Martin Pring's Market Roundup, you're going to find those behind the paywall. So you can usually get one of the two of the three, and sometimes three of the three writing in that ChartWatchers newsletter. So
awesome.
Anyway, with that, I know we need to close this down on this beautiful Tuesday.
It is a beautiful Tuesday because it follows a clinching Game 6 victory by the Caps on Monday. That makes Tuesday even better.
Yep, got to get that Caps plug in there as well. So weekly schedule, what do we have coming up the rest of the week? Tomorrow, we have our special guest from Raymond James, Jeffrey Sott. Dan Russo from Chaikin Analytics will join us on Thursday. And on Friday, we have the Everything Stock Charts segment. And I'm sure we're going to go over something very interesting, as we always do, about the website.
And I am also assuming that you would probably like to have some suggestions for your workshop next week.
Absolutely. Absolutely. I'm not really sure what I want to do just yet. So yes, suggestions would be welcome in that survey. If you can please take that.
Awesome. Well, one last quick peek at the market before we go. I can tell you the Dow Jones right now down 49, NASDAQ down 11, and the S&P 500 down 6. Russell 2000 still hanging in positive territory, up about 3 points. I do want to thank everybody for stopping by and joining us today. Please remember to complete that survey we were talking about as you exit. We do love to get your feedback to hear what you think of Market Watchers Live, and I know Erin would love to get some topics for her workshop next week. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. We'll see you back here on Wednesday. Take care. Happy trading.
Here's how to add a moving average for the volume on your charts. You can't use this volume component here, so go down under Indicators, select Volume from the drop-down menu, and then put the period that you'd like on it, and you can specify the color of the moving average line. Click Update, and that will give you this nice little line on here so you can see if it's above or below average volume.